On this episode of Pennies Going In Raw, we discuss this week in the market, theme changes, position sizing, and lastly, we have CarLotz CEO Michael Bohr.
Hey, yo, check 1, 2. This is Flavor Flav in the building for the Atlas crew.
Atlas Trading, what the fuck is up?
There are traders, there are prodigies, and then there's legends.
We're up 4%, baby.
No way.
4 fucking percent.
Buy the fucking dip.
Hey, who told me about IDEX?
Like, dude, what the fuck? Like, someone just made, like, a lot more money than me on my trade.
You find out life's this game of pennies.
Did you check the portfolio?
Pennies. The margin for error is so small.
I bet Warren Buffett never did that.
And they out there making money right now off of penny stocks.
Them two guys is putting in work to make y'all rich.
The pennies we need are everywhere around us.
Time to think big.
Pennies Going In Raw.
Featuring Dan, Deity Dukes.
And Hugh, honey.
Produced by Vinny Strokes, baby.
Welcome to Pennies Going In Raw. Today is Sunday, January the 24th, and we kind of have a little to brag about. AMC did a thing.
Yep.
NVIV did a thing.
Oh, yeah.
And you were completely wrong about SPY.
What? No, I wasn't. That's not true.
Yeah, SPY soaring through the airs. Your puts are worthless pieces of garbage right now.
Listen, all right. The SPY was definitely... Tuesday was a rough day for the P&L. I took my first six-figure loss of the year. You know what, though? I wanted to get it out of the way anyway. I mean, look, we said that we would see some weakness. We did.
Tuesday was a great day for me.
Yeah, listen, we said that we would see some weakness, but the caveat was that if the selling pressure was met with buying pressure, that our complete thesis would just go out the window. We were met with buying pressure.
Yeah, so you're like, yeah, my thesis will be wrong if I'm wrong, and then the thesis will be wrong. Yeah, there was some buying pressure, and yeah, SPY did really well. The one day that was weird was Wednesday. Wednesday was kind of a tough day. I think if you're holding some SPACs, even though the market was doing so well, SPACs did not like Joe Biden's inauguration that day.
Yeah, well, SPACs have been so hot for recently. I mean, what is it, like the last month? Have we really had a bad day for SPACs? Not really.
Yeah, no, we definitely, it's about time to get one. And a lot of people were freaking out because they saw the big ones that they were in all drop down and right before the votes and everything, especially when there were so many, like when the market's green, some people freak out and that's normal. But what we were just talking about was, let's kind of start with AMC. We kind of entered that one on last Friday at $2.20, and it hit around $3.70. Is that the whole short squeeze, or are we go into the price of a large popcorn?
No, I really think that this will be interesting because GME set off an entirely different theme. I feel like we've kind of been waiting for a new theme since bios ran, since weed ran, and not that those won't continue to run or those don't have more left in the tank, but GME set off a completely different theme, which is high flow percentage. And AMC, Fubo, they're all up there.
Yeah, I feel like AMC, it had its first initial run, but then on Friday, it was kind of doing its thing. But then whenever it saw GameStop, whenever it saw it go to $70, AMC decided it wanted to be part of the action. I feel like it kind of became a sympathy play to GameStop late Friday.
Exactly, and that's exactly how it works, actually. And I think that could be that could definitely be a theme for the week. Anything with a high short percentage might be the theme. I do think though that GME is quickly coming to its near end. Maybe one more day in it on Monday, but I would say by Tuesday, I would be shocked, not saying it can't happen, but I would be shocked if we were seeing still new highs on Tuesday of GME.
On GameStop, I bought like a $50 put at $61, and whenever it hit $68, the put was up 40%. It was I was like, how is this going on? I'm sure we have an episode on this. But yeah, IV was going crazy on those things. And yeah, that is one of the nuttiest things. I remember last week we joked and said GameStop was the biggest short squeeze of all time. Well, I think after what happened this week, can we say that it might be?
It definitely might be there. Besides Tesla, I would definitely. I mean, the market cap for GameStop is $5 billion now. They're going bankrupt, and their market cap's the highest it's ever been. So. I mean, I think that, but that being said, because we did have a lot of messages, for anyone still holding GameStop, I know I saw on Wall Street Bets, some kid turned 50,000 into 11 million on out of the money puts. Like, basically, he has a better chance. He had a better chance of getting struck by lightning twice, and he hit these out of the money options.
Out of the money calls or puts? You said puts.
Oh, calls. That's what I meant. Sorry. Yeah, calls.
Yeah, you keep getting confused. You're the only one that's short right now. This is bull gang in this market.
Yeah, well, you know, GME, and we can do an entire episode on this later, but GME gave great opportunities on both sides. So I was actually, at one point, I had both calls and puts for GME, and that's something that we can go into on another episode, but something that I've really been working on is seeing both sides and taking advantage of both the short side and the long side on something like GME, which is just ridiculous on Friday. And I think that that's something that we could definitely do an episode on in the future, is seeing both sides.
Okay, and the next thing that we just had to brag about, NVIV, usually we would have bragged about it last week, but we totally forgot. You called it 3 weeks ago on the 2021 trading episode at 80 cents, and it's trading well over $1 around the $1.40, $1.50 range right now. Did you hold it through all that? Like, what was the situation? Did it hit your price target? I mean, it's damn near 100%. So, I mean, there are a lot of people that mention it to me, and I'm like, oh shit, yeah, Hugh did call that.
Yeah, so it hit 180 after hours on Friday, and I really think that this is one of those that were kind of like MTNB, when we just kind of woke up and it was at $2. Someone who's really been influential in helping me with the bios, I won't say his name because he won't want his information out there, but he's been really instrumental with the smaller market cap bios, kind of teaching me like, hey, listen, dude, they run these down, and then when they're ready to go, they'll just start creeping them up, and 3 months later, you'll look back and be like, whoa, this thing was at like 40 cents. It's now trading at like $4, and it doesn't even have news yet. So, so I've been really working on seeing the bigger picture on some of these bios, and not just playing for 10%, but really seeing, okay, this has a $200 million market cap, and this potential drug that they're working on could bring in, 50 to 100 million inside the first year. Why is the market cap so low? This doesn't make any sense. This should easily be 10 times higher. And so we've seen that with MTNB and NVIV, is that with these smaller market caps that have a bigger float, we can take a considerable size on it and look back in 2-3 months and they've just uptick higher.
Okay, well, kind of transitioning into next week. So this past week we had a couple sketchy days, maybe just one sketchy day, just because of the whole SPAC situation. But other than that, it was a pretty strong week. What are you kind of expecting in the next week? And are you expecting the SPAC kind of resurrection? I know a lot of people are expecting Clove kind of to get a pop, and a lot of people are really pissed off about the UWMC downtrend, and there's a whole lot of but whenever you think about Fisker, whenever that one finally, everyone got so pissed at it because everyone was in it. Whenever the whole speculation on it changed, like you always said, that's whenever it started to reverse.
Yeah, and the great thing about FinTwit is that we can all share different ideas, and we can all kind of put our own information in and our own thoughts and ideas. The only bad thing about FinTwit is when everybody jumps on a bandwagon. We saw it with Fisker, we're seeing it with Clove. And so Clove, actually, after hours, I doubled my position in both my accounts and my parents' accounts, because I just think that this thing, let everyone blow, kind of like how we talk about from the short side, blow everybody out, let everybody get bored with it, and then that's when it's our time to shine. So Clove, I mean, I wouldn't even mind, these are buying opportunities. You have to ask yourself right now, and this goes for UWM as well, has anything fundamentally changed with the company? If you can't find one single reason, then why aren't you buying? If you're worried and you answer that question and you say, no, nothing has fundamentally changed my thesis, my outlook on the company, then that means that you're probably in too heavy at a too high of an average. And we talk about this all the time about not overweighing inside one position and spreading your eggs out.
Yeah, and we are going to touch on position sizing later in this episode too.
Exactly, because it's really important. Right now, I loved seeing these prices because then I can just double up my position. Hell, I'm hoping it goes a little bit lower and we can buy more because nothing's fundamentally changed. In fact, the only thing that fundamentally has changed is that we're seeing bigger partnerships inside the Midwest. If anything, that strengthens our thesis. So if you're not hoping for lower prices, then you probably are in too heavy, and that means that you have to look at it at two different things, which we'll get into position sizing later, but you have to look at your position and critically, and you have to look at the way that you go about your trading style. Are you going too heavy on your first quote-unquote nibble, and do you not have an entry plan and an exit plan? And we'll touch on that a little bit later, but with Clove, bring it lower. UWM, bring it lower. Nothing's fundamentally changed. UWM one day will be the number one, in my opinion, the number one mortgage broker, and we'll be sitting fat and pretty and rich. And so I wouldn't mind lower prices. If we go to $40, we're going to be wishing we got lower prices.
All right, and I know you wanted to talk about theme changes and position sizing in this episode. We'll get to position sizing after that. Before we get into theme changes, can you kind of touch on which themes that you are expecting us to kind of go into these next few weeks?
Yeah, so I'm really excited.
We're not financial advisors, by the way. Get that straight.
I'm really excited to have the Wolf of Weed Street on because I think that weed, although we might see a minor pullback, that when we look back in 4 years, when this administration's done, or we're looking, towards another election, that we'll be looking at like some pretty good undervalued weed companies that are like 10x. And so I'm really excited for the Wolf of Weed Street to come on. And I think that weed and EV will just be in a revolving door where, they're hot for 3 months, maybe take a month off. Hot for 3 months, maybe take a month off. Or anytime that legislation comes up, kind of like what we saw with like the drones back in April. Anytime the legislation comes up, that they're just going to be hot again. So,
man, with drones, it was anytime there was a picture of a drone online, someone would say it was with Amazon.
Yeah,
that one's had some nice pops recently too. Speaking of UAVs.
Oh yeah, original positions now up 1,700%.
Congrats, Longs.
Yeah. So, but yeah, so I really think that that's one of the things that we're going to see. And then the theme changes, like we talked about, is that GME set off the high short interest squeezes. And I think that we could continue to see this early in the week. But something to keep in mind, this is something that Ricky Bobby talks a lot about, is that you always have to follow the leader. So if we wake up on Monday and GME is sitting inside the 40s, that's probably going to kill momentum on a majority of the high percentage floats. So then at that point, it becomes only the high quality ones will probably run. And when I say high quality, I'm talking about your Fubos, your Go-Go, and your AMC.
It's time to fuck some bears.
Yeah, but WMW or something came up on my radar. Something where the stock failed data and now it has a huge short percentage. Something like that probably won't squeeze because it has a reason to be short. But something like Fubo or something like AMC where we're waiting on catalyst, that I could definitely see that squeezing no matter what. Like I said, Fubo, AMC, and Go-Go are my three favorite high short percentage squeezers for this upcoming week. But again, we got to keep our eye on GME. I said this on Twitter, but I'm definitely going to be looking short GME. If GME gets into the 100s, I'll probably be looking to take a position short. The market cap is like $5 billion right now. I don't think it makes sense, but I do think that Fubo and AMC will be some pretty big winners this week. And that's what I feel like this upcoming week in the theme change. But then something that Dan and I talked about was that all these little low floats are running massive. I think it was, what was that one Friday? ASCW? Was that the one that set it off?
ACST was one that ran. I'm trying to think. I was in... Damn, there was a couple.
Is it OWW or something? I don't know. I didn't play them, so I can't really, but the point of the matter is that what we're seeing right now is things with 2 million float, 3 million float, 4 million float. They're running like nuts and they're halting up. And this is usually the sign of a rotation. So we had the EV.
The AZRX?
AZRX too, yeah. I mean, that one squeezed. That one squeezed. Yeah, that was one of them. It was like 4 of them. AZRX, ACSW, I think it was OOW, and there was like a few others. But anyway, the moral is that we're seeing these low floaters run 100% on no news. And what this usually tells me is that, okay, we had January poppers, we had the bios, most of the bios went. I mean, don't tell anyone, but if you're in BNGO, I think that one is, I think that one's getting close to being bought down. BNGO went from 50 cents to $11 in 1 month. I think that on almost no news. So I think that one's getting ready for the market cap on that is like 2.6 billion. That's a load of nonsense. But what I'm saying is that now that we're seeing the low floats run, okay, the next rotation is going to be back into swings because, not everything will just be running to run, or things won't be running 1,000% in a day off, fluff news. So I think that's why I recently said, swings, I'm looking to add some swings because I think that we're going to see a rotation to low floats for the next week or two. And then the next rotation, low floats will chill for a little bit. And then that's when the swings can really come back.
All right. Well, I guess kind of one last thing to touch on theme changes is how do you kind of see the theme changing and how do you predict what theme is going to be next?
Yeah, so part of it definitely takes experience. Being around, January poppers for whatever reason. I'm not good with low floats. I'm not really good at scalping. That's not my game. So, we see a theme like that in January where low floats run like wild. And so part of that is just knowing kind of like the seasonality of what runs when. And then once you get the first one to run, that's when you have to adapt and change. Zach talks about a lot. We talk about it in Atlas a lot, is that you have to adapt or die. So when we see low floats running, okay, but then all of a sudden a weed ticker runs 2,000%. Now we have to start looking towards weed plays and see, okay, is this going to be the new theme or is this just a random go? And that's when you really have to, that's why you have to create scanners. And when your scanners start lighting up and you start to see, we talked about it, relative volume, 2 to 3x on the daily, that's when we got to start looking for a new theme. Or I was on FinViz on Wednesday night talking to Bob, Incredible Bob. And I couldn't find, I'm looking for like a really good play. And there's just not many bios left that are undervalued. You really got to start looking because pieces of junk like GEVO are running, 2,000%. Their market caps are in the billions, and the companies may be worth 100 million. So that's when you have to start looking and saying to yourself, okay, we don't have that. Like, what else can run? And so based on seasonality, knowing the stocks, stuff like that, that's when you have to start looking for a new theme.
All right. Well, before we get into the Michael Bohr interview, let's touch on position sizing. We get a lot of questions on position sizing. How much of their account should they be putting in? What should their entry be? Et cetera, et cetera. And there's a bunch of different answers. What do you think is the best way aside from just saying, okay, if you want 20% in there, start with 5 and then do your next 5% ads on the dips?
Yeah. And so we can't tell you what your risk appetite is or should be, but something to note is that how do you got to think about your risk to reward parameters. And so we talked a lot about my 10 step matrix. We talked about it a lot. And part of that is knowing, okay, am I a little too bullish on this? This thing's up a good chunk. How much more can it really go? Should I really be taking a full position at this time? And we touched on a little bit earlier about Clove. Okay. If you don't like this price at Clove, I don't understand why, unless you found out some information that I don't know. We're just Clovex is expanding into the Midwest, and they have 4 catalysts upcoming inside the next week and a half. You should be hoping for these dips. So part of that comes with, okay, do you have a plan? So I know that when I take a position, I say, okay, here's my starter, and my starters. I usually keep my starter about the same. It's about, let's call it 3% of my entire portfolio is my starter. Okay, and then I say, okay, I'm going to add here on support, and I'm going to sell some here at this price target or resistance. And by doing that, if it hits my stop, or if it hits my support, then I'm adding automatically. Okay, I don't have to think twice about it. Okay, but again, when I add, I'm adding 3 times that original position. So now I'm only in about 10% of my portfolio. So then if it goes even lower, then I'm taking another 5%. So now my max that I'm in is 15%. So I'm not complaining if it goes even lower, because then I can just add another, another 5% is 20% of my portfolio. Is that going to blow me up if this thing goes to 0? No. But if it goes 100%, is that going to be nice? Oh yeah, that's going to do wonders to my portfolio. So you have to have a plan. You can't just say, oh, Zach Moore said to add, let me add 60% of my portfolio. Okay, right now, does that work for most plays? Sure. But it's all about when the tide changes. And when the tide changes back to a slower market, and let's just say that, Zach calls a play and it goes up 20% on his initial call, and then in 3 days it's down 15% because things aren't following through as nice. Now you're going to be down a boatload, and if you're in 60% of your account, you're going to be stressing.
I mean, that we all saw it on the Fisker play.
Yeah.
Back then it was SPAC, and when it was down so much, it ran to, I think, above 20, maybe 25. I can't remember exactly. But the fact is, whenever it hit 8 or 9, people sold at the bottom. They couldn't take it anymore. And the same thing with ONTX. Something can go bad at any time. I mean,
exactly.
there are humans involved in these companies, and they really can go down 70%.
Exactly.
Instantly.
Exactly. And so I think that it's really important. And the question that I've asked a few times throughout this podcast, and something that I like to ask myself, is that, a lot of people like the add when you're sad. Yeah, okay. But what I like is the saying, has my thesis changed to the downside? Do I still believe in this company? If that answer is yes, then I'm adding. There's no doubt about that. I'm adding because my thesis hasn't changed. The only thing that's changed is that I'm seeing some red. So we talk about it a lot, and about when one of the biggest things about becoming a better trader is not just cutting when you're red. I saw it on Twitter yesterday. Someone added, me, Dan, PJ, and Zach. And he said, one of the most fundamentally changing things for me as a trader was realizing that I have to add when I'm red and sell some when I'm green, which kind of goes to Dan's portfolio, his entire strategy. And he said that this completely changed the way that his trading, the way that he trades, and it also changed. He went from down 60% to now up 500%. So I think that that's a really good point that, if you need to, take a sticky note, write on the sticky note, has my thesis changed, ? Now, again, failed data, maybe the management comes out and says that, just kidding, Nikola isn't a hydrogen company, and, they're making toy trucks, something like that, then okay, yeah, your thesis has changed. But if you can look at Clove or UWM or any of the other ones and say, has anything fundamentally changed with this company? If you sit there and can't find a reason after thinking for 2 minutes and going through the fundamentals, going through the financials, and you say no, then you should be adding. And so to get to our point about position sizing is that you need to create a plan before you enter a stock, and you need to decide where you're going to add, where you're going to cut, and how much you're going to go in. I know one guy who says that he has 2 different roads. Okay. If he feels super confident about something, his starter is 10% of his portfolio. If he doesn't feel super confident, it's 5%. And then again, his ad spot is going to be 10% of his portfolio versus 5% of his portfolio. So something even as simple as that can help. But this whole going in 60% on your first starter, that has to change, because in a normal market, or even a market like August, that will not work.
Yeah. I mean, and the thing is, like, I don't have more than 10% of my account in any stock, hardly ever, unless it's like just fantastic, just because my risk reward is, or not my risk reward, but my risk tolerance is a lot different than most. And the only time I really, really just load in on one buy is if I notice an overreaction in a sell-off. I mean, you saw it even on some UWMCs and CarLotz on, I believe it was Friday, just had crazy drops, and then they bounced right back up real quick. And I sell those because, I mean, maybe those drops happen for a reason, and it just hasn't happened completely yet. And that was just a big dog that sold a shit ton of shares, you know?
Yeah, they're just trying to get out, yeah.
Yeah, so I mean, and you'll kind of see that in bio plays too a lot, and that always sketches me out. But yeah, I mean, other than that, it's all about your own risk management. And I mean, you see people like Zach. He's saying, I mean, although he has a shit ton more money than most people, he still puts in a ton, in a lot, and because he knows what he owns and has conviction in them. And that's also another thing. But I feel like a lot of people that are so worried about position sizes don't have conviction in their plays.
Yeah, and just because now I'm kind of fired up. Right now, I feel that the market is paying chasers. Okay, and if you're a chaser, I want this to be your wake up call, because if you've been chasing for the last 2 months, you've probably been still making a pretty penny. If you've been going in 60% on something up 200% during the day, you're probably still making some money. But I want you to understand that there will be the time when the tide changes, and that you'll be buying the top and you won't have any money to add down. So if you're a chaser, okay, right now the market is super hot, and that's a really good thing. But at the same time, chasers are doing really well. And that scares me, because when the tide changes and the chasers are buying the top, and then if something starts to go down, they're just going to sell into it, because they're like, oh, shoot, get me out, which is going to cause an even bigger dip. Just be ready for when that tide does change, because right now we're rewarding chasers because the stock just goes higher. Okay, if you chase GME at $45 or $50 a share, you still made like 25% in a few minutes. So chasers are being rewarded right now. But when that tide changes, okay, we have to be ready for it.
All right, and with that being said, I think it's time for CarLotz CEO Michael Bohr. They just went public this week, from ACAM to LOTZ. We hope you guys enjoy it. So today we have on Michael Bohr, the president and co-founder of CarLotz, a consignment company for vehicles that essentially makes the process of buying and selling a used car that much easier. Was that a good description?
That's a great description. Thank you. Thanks for having me.
Hey, yeah, thank you for being here, and congratulations on going public. It is currently Thursday, and tomorrow the ticker will change to LOTS. That's correct?
That's what we hope. There are lots of mechanics like within the NASDAQ exchange, and so all these things can always like slip a day or two. But that's the goal. Is we're pointing towards tomorrow, Friday, as our first full official day of trading as LOTS.
So that's awesome. You were an investment banker prior to this. Did you just have a car sale go completely wrong where you were like, damn, I have to make a whole new company to fix this?
That would be a good story too. No, I mean, I was an investment banker. I was actually really satisfied with my career. I love the guys I worked with. I just always knew that at some point I wanted to be an entrepreneur and start my own business. Kept a notebook with a bunch of business ideas. I traveled a bunch in my investment banking life. And so when I would travel, I would write down some business ideas. I'd probably write the business idea at the top, and I'd try to fill up the page with a one-page business plan. And by the time I got to the end of the page, I'd usually realize that it was a horrible idea. And so if it made it past kind of page one, then I would take it home and talk to my wife about it. And then, a lot of them got crushed there. And so this one made it past the one-page business plan. It made it past the scrutiny of my better half. And fortunately, we're in Richmond, Virginia. It's where I live. And there's another used car business that is headquartered here with a lot of very successful and smart people who know the industry well. So, got the good fortune to spend some time with some of the founders and early investors in that business, and really kind of learned a little bit about the industry as I was writing the business plan, which was very helpful, gave me a bunch of confidence. But, essentially the way the idea came about is, I would drive home every day from my investment banking job, and this one road that I would go down, it was a fairly busy road by Richmond, Virginia standards, but people would park their car on the side of the road with a for sale sign in the window. And it always occurred to me that was a really inefficient way to sell a car. I mean, you're relying on a minimal amount of traffic down this road to see your vehicle. Maybe you're listing it on Craigslist, so you're really exposing yourself to all that comes with the Craigslist universe, which is, hassle, time commitment, potential danger. And so what's interesting is I was an investment banker, but I was focused on mergers and acquisitions. And an M&A banker, the job is you meet with clients who have an asset, you work to professionally market their asset, and you sell their asset for them to a buyer, and then you take a fee. And so what we do at CarLotz is essentially that for cars. We meet with people who have cars to sell. We work with them to professionally merchandise and market their vehicles. We find buyers for them, we sell them, and we take a fee. And so it's actually, my investment banker colleagues, former investment banker colleagues probably don't like the comparison to a used car dealer. It still has negative connotations, as does investment banking actually. But, I think what we're doing at CarLotz is very similar to M&A investment banking, just a much smaller asset and obviously a much smaller fee.
That's an awesome way of looking at it. So I guess to follow up, you could have gone down the road of, going public by yourself. Why did you choose the SPAC route?
Yeah. So when we started the company, we raised about $500,000 from local investors. And this was 2011. And what we told our investors is we would go and we didn't know whether it was going to work, right? This was 2011. It was basically an 80-page business plan, a 20-page PowerPoint presentation, and like me saying, never having run a business, saying, I think I'm going to turn this into a big company. So not surprisingly, a lot of people were like, you're kind of crazy, anyway. So we raised the money, but we told our investors back then that what we were going to do is we were going to grow this business, and we wouldn't seek additional capital until we either made money or were darn close to it. And so at each capital raise, that's what we did is we would try to create a profitable business. And when we got close to it or achieved it, we would go and raise additional capital. So we did that in 2012 with our second round of capital. We did it in 2014 with our third. In 2017, we partnered with TRP Capital, which is formerly officially Roger Penske's private equity fund, but since has kind of spun out, but still affiliated. And we raised the headline number was 30 million, but we were going to take it in tranches. And we ended up taking about 20 million by the time we got to a point where we were like, okay, we've now gotten it back to profitability, or close to it, depending on how you look at profitability. And we said, hey, it's time to raise more money. But where are we now? We started as a local business. We made it regional. We made it super regional. We made it semi-national. We've now opened in markets where nobody knows us, and the openings have been successful. We know how to open new hubs. We know how to bring on new accounts. We know how to sell cars well. We know how to source cars well. Let's go for the big raise and the big growth. And so we built a plan that essentially takes us to be a national business, a multi-billion-dollar auto retailer, and it required an amount of capital that a traditional way IPO doesn't really get you. You know, a traditional way IPO, you typically raise $100 million or a little bit, and then you go public, and then you use subsequent rounds to continue to raise capital. But this going the SPAC route enabled us to raise an amount of money that was going to take us through our growth plan, and it enabled us to also partner with this group, ACAM Partners, which is a group of very seasoned, successful investors that have decades of experience investing in and growing multi-billion-dollar consumer and retail businesses. And so it just seemed to make sense. The bankers were that we were working with, very positive on the concept, and there was a tremendous amount of interest as we went through the process. So thrilled to be at this point in the process, hours away from closing, hopefully, and hours away from trading on the NASDAQ as LOTZ.
Yeah. One thing that you just touched on was how you plan to go nationwide. Right now you have, I believe, 8 locations in 5 states.
That's
right. I don't want you to give away your whole super business plan, but location-wise in 2 years, not just number of locations, but do you plan on expanding in that short amount of time?
Yeah. So we're currently in Virginia, North Carolina, Florida, Texas, and Illinois. We announced, I think last Monday or maybe the Monday before, we're opening in Seattle area and in the Orlando area. And our plans are to open 3 to 4 new markets per quarter over the next several years. And there are really 3 reasons why a new market or new location is attractive to us. One is it gives us access to a totally new market. So, for example, Seattle is a totally new market for us. We don't source vehicles from the Pacific Northwest. We've sold vehicles into the Pacific Northwest, but certainly not as many as we will once we're more established in the region. And so it's essentially a total add-on, doesn't kind of combine with any of the current business we're doing. The second reason is capacity. So, for example, in Virginia, we're at capacity. We really can't take another vehicle. We have limited parking spaces across our hubs. And so we are seeking additional locations in Virginia, even though we're already in Virginia, but just to give ourselves more capacity to take in more cars and sell more cars. And the third reason, which I think is the most interesting, is really cost savings. So right now we have clients who send us vehicles from the Northeast for us to sell, but to do that, they have to ship them to one of our locations. So our closest location to, northern Pennsylvania might be Chicago or Virginia, and that might be $600 or $700 of shipping. So if we open in, let's say, Massachusetts, and shipping to our location goes from $700 to $300, then our clients save $400. The value that we add to them goes up by $400 just by having that extra location. So a lot of these new locations are really exciting because the value that we already provide to our clients will go up because their cost of shipping will come down. And so we're thrilled about this capital that's coming into the business, our ability to use that to grow the business, attract more vehicles, reduce the costs of doing business with us for our clients. It's very exciting.
Yeah, that's awesome. So you guys have seen ample growth, just massive growth. And part of that is due towards, I would assume, towards the used car bubble, some are calling it right now. They've seen a huge increase in the amount of, used cars that are being sold. And obviously that drives, supply and demand. So how do you think that this will play into your growth? And do you expect that some of your growth to decline as this used car bubble declines?
Yeah, I would, we've been in the industry now for almost 10 years, and I would probably argue with the used car bubble concept. If you go back, there are essentially 40 million used cars sold every year. If you go back 2 decades, it's pretty much 40 million every year. In the depths of a recession, in the peaks of a boom, it might go from 40 to 39 or 38, maybe 37, might go from 40 to 41 or 42. But what's great, what I love about the used car industry is it's remarkably stable. It's a need. It's not a want. I mean, people can adjust how much they pay. They can adjust whether they finance it or pay cash. But at the end of the day, they need a vehicle to get to work. They need a vehicle to take the kids to school, to go to church, et cetera. And so what we've seen is what changes in the used car market is pricing. And so, if you're feeling flush, everybody's working, unemployment's low, you might buy a $30,000 car instead of a $20,000 car. Or if you're out of work and your car breaks down, you might go from your $20,000 car to an $8,000 car. And so that has implications for dealers that trade on pricing. We sell cars for people at a fee. And so, and the fee is flat. And so whether we sell a $30,000 car or an $8,000 car, there are some minor differences to us, but we're going for that volume. And that volume has been remarkably steady over time. So what we've seen recently, and maybe this is to your bubble point, is we have seen pricing go up for the same car. So like the same car that was the exact same car, just 1 year different, that was sold for $18,000 last year might be $19,000 this year. It's not 18,000 to 28. I mean, it's, they're minor differences. And so we've seen some average selling prices go up with our peers and with us. Our average selling price has actually gone up fairly dramatically, but that's mostly because of some new clients that we've brought on that have shifted our average selling price up. We've brought on clients that bring us, $40 and $50 and $60,000 pickup trucks and luxury vehicles. Whereas if you go back 3 or 4 years, we were primarily in that $13,000 to $15,000 average price point. We're now, north of 17. So there's been some good price appreciation, but at the end of the day, we're looking for that volume, and that volume has been remarkably steady.
So with the growth that you've kind of been experiencing, do you kind of expect, and continuously speaking about the used car market, do you kind of expect it to be flooded with non-EV cars in the next 5 to 10 years, especially with how it's been going recently?
Yeah, I mean, I personally love the shift to EV. There's some great EV vehicles. There's some great both highline and kind of everyday vehicles that are coming out. They're EV. The whole shift to EV, I think, will probably be a little slower than some predict. It does have an impact on the industry, but mostly on the franchise dealer side of things. Franchise dealers actually make quite a bit of their money on parts and service, and electric vehicles require fewer parts and less service than an internal combustion engine vehicle. And so that will definitely impact, new car franchise dealers more than the used car sellers. At the end of the day, an EV for us is the same as a, internal combustion engine vehicle. It's a car that we can sell. We are, putting in more charging capabilities at our hub locations to manage through what we think will be a slow and steady rise of EVs going through the used car market. If there's a more dramatic or faster shift to EV, there might be some more depreciation or lower residuals on regular internal combustion engine cars. But that's something that we're thinking through real time. But yeah, no, it's really interesting. I think, if you go back probably 2 or 3 years, there was a report that came out that, essentially said that between electric vehicles, autonomous vehicles, and car sharing, that the traditional dealership model will go away. And by like 2022 or something, it was a prediction of this dramatic change in the way cars are bought and sold. But what we've seen over time in this industry is that this is a very old industry. It involves 100 million cars that are out on the road being used by people. It's just not hundreds of millions of cars on the road. It's not an industry that just moves very quickly in any one direction.
Yeah. One thing that my actual previous job was working at a company that did training for cars, RVs, and boat dealerships, and also the service industry. And that was one of their constant concerns was with cars being delivered, what are we eventually going to do? But a lot of the dudes there that had been there forever, and it was a small company, but they were so confident that this wasn't going away. And I think that may just be a car dealership.
Well, yeah, I mean, some people like have confidence in their industry not changing because they don't want it to change. And you can think back to like Blockbuster, what they were thinking back in the day. I think the change in the industry, we see there's change. I mean, I'm telling you, there's change. More people are buying EVs today than ever before. And that will continue to happen. I think what I'm suggesting is that won't necessarily have as big an impact on the dealership market as, maybe some predict.
Yeah, I feel like just the aspect of going to a dealership and test driving it and instead of just buying it. But then again, I mean, ordering everything online just seems so weird just 15 years ago.
Yeah, no, absolutely. I mean, I think when we think about so we have this omni-channel experience where you can buy a car fully online and do it all, from your desktop or mobile phone, or you can actually come in and deal with some of our coaches and work with our people. So it is truly omni-channel. When people say they don't want to go to a dealership or they talk about the slimy dealership or, I don't want to, people remember kind of the 70s or 80s caricature of a guy in a leather trench coat sitting out front of the dealership, smoking a cigarette, waiting for the next victim and, pouncing when you show up on the lot and then being stuck in the finance manager's office for 4 hours and the coffee's cold. And, that experience is, it's largely a caricature. I know one of our competitors still uses it in their ads, which just, I don't know, most, if you cut the dealers between those doing it old school and those doing it the new way, there are plenty of dealers that provide a wonderful level of service and people have a great experience. So if you take the fact that old 70s or 80s caricature is going away, what does the guest, the car buyer really want? They want a good car, the right car. They want it at a fair price. They want to be treated fairly and with respect. And so if you can do that in person, or you can do that online, or you can do it both so that someone begins their journey online and then transitions to maybe they want to see the car before they buy it. We think there's a model there that leads with treating the guests with respect and fairly and provides them a great product at a great price that we stand behind. And then how they want to do it, whether it's fully online, fully face-to-face, or somewhere in between, we actually don't care. We want to provide them the same level of guest experience, regardless of how they shop. And I think that's key. I think there are lots of people who are coming at this with online only. There are lots of people who are saying, let's try to keep people going to our store because we have people there and we have infrastructure. We're truly agnostic. However you're most comfortable buying a vehicle, we've created an experience that will wow you.
So you did just touch on competition. How do you guys feel like how do you compare to your competition? There was a different company that went public recently. First three letters are the same, actually. And just how do you differ from them? And with that being said, do you see your size, or do you ever see CarLotz growing to the size of something like Carvana?
We have a ton of respect for all the guys who've gone public in this space have done amazing things. They've transformed the industry. They've taken it forward. They're providing phenomenal experiences to car buyers. So really, I think there are a lot of old school car dealerships that are still on a dirt lot with a chain link fence around it and no website presence, no transparency of pricing. I think there are a lot of car dealers that need to get with the times or move away from the industry or kind of find something different to do. There are plenty of dealerships and dealer businesses, auto retailers that are doing a wonderful job. And I would consider all of our public peers in that space. Where we differentiate is we source our vehicles differently. Obviously, we are a consignment business at the core. That's how we started, and that's how we are today. And so we provide a service to the seller. We sell their vehicles for them for a fee. And we do that by providing a wonderful experience to the buyer. They can get a great vehicle that we stand behind at a fair price and be treated fairly. And so, fundamentally, where I'd like to compete with all these other great companies is on service. I want people to leave their CarLotz experience and say, holy cow, like I'm never shopping anywhere else for a vehicle. And, we don't always, like we step in potholes, occasionally. We're not 100% doing that today, but that's our vision, is like, we want to make sure that we're creating the world's greatest automotive retail experience. And I think by doing that and continuing to offer great vehicles at a great price, we will compete very favorably with everybody else in this space. The beauty of this industry is that it is not a winner take all, and it's not even a couple winners take all. It's not like Home Depot and Lowe's, or even McDonald's, Burger King, and Wendy's. It's there are thousands and thousands of dealers. The top 100 of them only account for 6% of the volume in the market. And so there's room for a Carvana to sell 1 million cars, alongside of room to sell 1 million cars, a CarMax to sell 1 million cars, and a CarLotz to sell 1 million cars. And so that if all 5 of us sold 1 million cars each, which is way more than any of us sell today, even the largest, we'd still be, about, I guess, 12% of the market. And so there's a lot of room to grow. I think we're all going to be growing very quickly. Our job is to grow faster, and we're doing that currently, and we're going to keep doing that. So yeah, we'd absolutely love to be the largest player in the space one day.
Great.
Definitely. And from, an investor standpoint, one of the biggest things that investors worry about is 2 things. Is one, getting an offering or a secondary dropped on them, at a discount. So how much capital, or how long will this capital last you? Will you be looking to raise within the next year, next 18 months?
So, like I said earlier, it was important to us to raise an amount of capital that would allow us to execute on the growth plan that we've laid out. Our growth plan has us adding 3 to 4 new hubs a quarter over the next several years. That is all doable within the bounds of the capital that we're raising through this transaction. And so we as we grow, and we're a fast growing business, as we grow, there are certainly going to be opportunities. And so I can't come here today and say we will not raise additional capital. If there's a reason for us to raise additional capital because there's a new opportunity that's outside of the bounds of the business plan that we put out there, like we will absolutely, to the extent it's a prudent thing to do for shareholder value, we'll absolutely do that. But in terms of the plan that we're currently executing, it does not require capital in excess of what we're raising in this transaction.
Definitely. Just my last question was going to be about the share structure between, ACAM and CarLotz. Do you feel that the share structure is fair and will maximize shareholder value?
Yeah. So, the way it plays out in this transaction is the ACAM, at the end of closing, the existing CarLotz shareholders will have a little under 60% of the business. The ACAM shareholders, including the ACAM shareholders and the ACAM sponsor, will be about 30% of the total. And then the PIPE investors, there's some strategic and some financial, will be about 11% of the business. And so, we think we and the market seems to think this is a very fair deal. We're thrilled at the outcome, and we're excited to kind of put the deal behind us and go forth and execute on our vision.
Perfect. Well, one last thing before we get you going, if there's anything you want to touch on about the future of CarLotz, plug it now. It's time.
Well, thank you for giving me the opportunity to speak with you guys today. I would love for everybody who's listening to this to consider us as an option when they are looking for vehicles. I think we compete tremendously well on price, tremendously well on service, and experience, both online and in person. And so, if there's one thing that comes out of this, is that a bunch of your listeners check out our website and buy some cars from us, I'd be thrilled. We're absolutely, as a team here, we are super excited to get this transaction behind us, go forth, open these new hubs, take what we're building across the country to so many more potential buyers, potential sellers. It's absolutely going to be thrilling. One thing that we didn't touch on, actually, thinking about it, is we started as a consignment vehicle for the consumer. A lot of our business is now with corporate sellers of vehicles, but still 15+% of our business comes from consumers that are looking to consign a vehicle with us. And what that means is, as a consignor, you're not taking the dealership offer. You're not dealing with the hassle of selling it yourself. You're basically getting more money and not having to deal with the hassle. So again, in addition to being a great place to buy a car, we're a phenomenal place to sell a car. One of my favorite taglines for this company is "More money for your car, more car for your money." And I think that's a great way to end it.
Awesome. All right. Perfect. Well, thank you so much for joining us. Anytime you want to come back on, just let us know. And congratulations again.
Thanks, guys. It was a pleasure to be on with you.
All right.
Thanks, Michael.
All righty. Thank you guys for listening to another Pennies Going in Raw. We did just drop the 300 shirts. We have like 30 of them left. We are going to give some away from free and some giveaways and stuff, but we did sell out just about all of them in the first day. Super crazy. Thank you guys for supporting us.
Yeah, follow PGR Pod on Twitter because the people who were following PGR Pod were the first dibs on the shirts.
Yep.
And that's probably where we'll do one of the giveaways. And will we do some in Atlas?
Yeah. We'll do some giveaways on the announcement channel in Atlas. Probably around 4 or 5 there. And maybe if you're lucky, you'll get one. And we'll be sure to open up a Shopify store soon and get the mugs, get the hoodies, get the hats, get everything, the mask to you, and maybe even a tank top so you can be have a hot boy summer, huh?
Looking forward to it.
All right, make sure to give us 5 stars, and we will see you next Sunday. Thank you for listening. Peace.